Right. Welcome back. Now we're going to discuss um, market models and um, apply it to a particular litigation in the context of an event study. All right. So before we dive deep into it, I want to expose you to daily data. Okay, earlier we have done so far monthly data, we have downloaded daily data. Daily data are really, that's the way we can proceed now because we have the computational abilities that we did not have even 2 decades ago. So, but as I mentioned earlier, a lot of the CAPM you will still have to do with monthly data. In addition to doing it with daily data, you will still have to do it with monthly data in order to have results that are comparable to results that were done, let's say, in the 1980s, all right? Because you just did not have that kind of analyses that were done, betas that were calculated using daily data going back to the 1980s at a reliable level anyway. All right, so, but for market models, because it's a much more, as we'll see empirically, it's much more free-flowing, there are many more degrees of freedom, and which I'll get to in just a second. But in this case, our daily risk-free return data are, we get that similar data from Fred. Just as we got monthly data, we would get daily data. Now, to remember, there are two different issues. One is daily return is the return that you get on that security on the holding period of that day. And the other is the maturity of a particular security. So you can have a US Treasury, US federal government debt that matures in 10 years that still will have daily returns, monthly returns, and so on. All right. So you will need to be careful what it is you're doing in terms of looking forward. When you're doing the market model, because we don't actually calculate excess return directly into the equation, what we do is let our data tell us what the coefficient of the risk-free rate of return ought to be. The risk-free rate of return is just another right-hand side variable. It's just another regressor. The CAPM forces you to give it a particular form, right? It is beta minus, beta plus. Okay, now where is our? All right, so here it is, the RFT is plus beta. So it is, yeah, 1 minus beta, right? Over here, you can rewrite this as R of the RJT equals alpha plus beta RMT plus 1 minus beta RFT. 1 minus beta is you're imposing that as a requirement as part of the CAPM. In the market model, we are not forcing a constraint on the regression, right? So that's a big advantage. And so we actually have more flexibility in terms of what risk-free rate to use. Because now here is what we really need to understand. The market model is an empirical generalization of the CAPM. What we have in the right-hand side, on the right-hand side, we say, you know what, let's consider all potential variables that we need to control for, and we can put them, as long as they're meaningful, as regressors. That's the gem of the market model, because we are not really trying to put in as much of a theoretical interpretation of these various parameters as we had with the CAPM, because we have that freedom. So as a result, we also have the freedom in terms of how many variables we put in and what the interpretations of all of those are. So in particular, this particular, we let the coefficient of the beta be determined by the data here. Whereas in CAPM, it was determined, it was one of the constraints as to what the coefficient of the risk-free rate of return had to be. Similarly, we put we force no constraints on the nature of the beta MJ, which is the coefficient of the market return. This here is an example of additional return additional variables that we might want to control for. In this case, RCT is the average return on day T of comparables. Basically, the idea is, and particularly this holds a lot with compensation. For instance, you are the CEO of a company and you are trying to say, well, this whole industry was affected in a bad way. All right. So if we are trying to isolate what is specific to this particular firm, then we say, all right, we are going to control for the RFT, which is how the entire debt market, the returns was going, the risk-free. That's kind of a no-brainer. That needs to be controlled for. It typically varies very little, so it doesn't have a whole lot of power. RMT is we're saying we're controlling for the entire market. How did the market do as a whole? RCT is where you're controlling for how that particular industry did over the relevant period. Some of you have done in your weekly assignments on energy firms, and that's the kind of thing that you will need to do, is to control for movements in the particular industry. Is that necessarily a good thing? Should you be controlling for movements in the relevant industry? Okay, that's the kind of economic question that you need to be answering. That's not an empirical question. That's a question that your finance theory and practice should inform you about what variables you need to bring in there. So one of the things that we often do is if you have, let's say, Alibaba, and you're looking at its returns data in the US stock market, then you will also typically have, given that a large portion of its business is in China and denominated in RMB, you should have a control variable for the exchange rate in there. All right. So similarly, those are, or if GDPs for different countries, you would need to put in there. Later on, when we do firms, a Brazilian firm also doing business in the US, you would put in controls for those kinds of movements as well. The market model is, as I mentioned, it's an empirical generalization. It's a much more intellectually, empirically free model, which allows you to experiment a lot. But of course, anytime you're experimenting a lot, which means you also have to be very careful to make sure that your results are not are sufficiently robust. So that's so in our particular case, a lot of times, especially in litigation, this idea of identifying the comparable is something that often a lot of time is spent on. Could be in the same industry, could be the same or similar size. Those are the kinds of judgments one needs to make. What I do, for instance, in most of my research is to have an objective basis and taken for, so like I can say the 2-digit SIC code, which is the major industrial sector of, so all the average, identify all the firms in the same major industry sector and take the average return for all of those firms. That would be an approximate, that would be one way of looking at returns of comparables. Okay, it's not quite, there is no straightforward rule, and what one needs to do is to make sure one looks at various different such comparables. One can also, in addition to finding comparables of firms, you can also use relevant industry indices. So for instance, if you're looking for if you're looking at a tech firm, you could use the average for the NASDAQ as the return for which you will control as one of your regressors. All right. So those are all of those things that you need to look at. So let's look at Wells Fargo. All right. So this is here Wells Fargo data. We are looking at daily data from January 2010 all the way till the middle of 2018. We have Wells Fargo daily returns, T-bill daily rates, S&P 500 daily returns, and as our comparable, we say, let's take Bank of America. We know Wells Fargo is a bank. All right. For our market returns, we'll just take the S&P 500. We could do the Dow Jones, you could do any of the others. And what you would do in a litigation situation, for instance, would be to have, see if your results are actually robust. In this case, for the industry, let's say we take Bank of America, just take another bank. All right. So, so that's the market model. Simply then, now one thing to keep in mind, our market model does not force excess returns to be together. That is to say, the return minus the risk-free rate is not a left-hand side variable as it was in the CAPM. The CAPM, they force those returns and the excess returns and the risk-free rate to come into the equation in a particular form. In the market model, we're letting the data actually tell us what the relationship ought to be. All right. So in particular, therefore, over here, the Wells Fargo daily returns, as we have seen from the data, these are the Wells Fargo daily returns. These are the T-bill daily rates. These are the S&P 500 returns. These are the comparable returns. All right. In this case, for simplicity, we're just saying we're taking one particular bank as the comparable. You could do a different bank. You could take an average of all banks. You could take a financial index for the banks. All of those are perfectly legitimate, and there is no one answer to what the appropriate market model ought to be. The answer always is, are our results robust? Okay, how do you then go? So you're going to regress column B on column C, D, and E. So let's do that. Go to data, data analysis, regression, input Y range, starts B, this this takes a while. It's very annoying because they're, you know, this is daily data up to here. All right, that's our Y data. Make sure, yes, labels are in there. And in this case, we are going to make our lives simpler by, instead of H2, this is C2 to E2139. E2139. So, you know, because we would have to go through and figure out again 2139, we are going to now simply say C2, because that's where this starts. We know it's CDE, C2 to E2139. Labels, yes. Constant, absolutely no reason for us to insist that the constant be 0 for the market model. All right. So the new worksheet, let's say it is WFC market model. I made exactly the same error as I was telling you not to. Let this be a good example of here. Instead of C, it's B1 to B2139 for the Y range, because I've included the label, which I should do for the X range as well. So That's how it should be. All right. So it's calculating the regression. This is how we are going to look at. Now, if you did not have the labels in there, these things would be, you'd get them all mixed up, which one is which. That's why it is so important to make sure that you have the labels in place when you are doing your regressions. The intercept is relevant. The significance of the p-value is practically zero. So our model is, it's total number of observations over 2,000. So yes, you're going to get very, very significant results. So that's very good. Now, this is the thing to keep in mind. These coefficients, unlike in CAPM, because we have not imposed the kind of discipline on the empirical model, so these numbers don't really mean anything because of what we call, because of multicollinearity problems. You can have them mean things, but then you'd have to impose much more conditions on all that stuff. All right. What we do need to know is these p-values, whether they are significant. All right. So in particular, we find that the S&P 500, it is the return on Wells Fargo security is significantly dependent on the S&P 500. It's positively dependent, and it is significantly positively dependent on the Bank of America daily returns as well. All right. Those are all great things to know. What we also need to know, and this part here, uh, uh, idiosyncratic risk. Okay, it's 0.93%. Now, this is the thing you need to remember. This is daily volatility. What we did when we were doing CAPMs, what we were calculating monthly volatilities. All right. Later on, we will find that this is daily volatility. In order to convert it into monthly volatility, you have to multiply it by the square root of the number of days. In order to, so in this case, you'd multiply it by square root of 20. If you want to 20 trading days, that would be the because that would be the number that would make sense in order to get compare. So let's just do that. So this is equal to 20 time raised to the 0.5 times. All right. So this here, the 4.16%, that is the monthly volatility of Wells Fargo security, Wells Fargo stock, which that number is comparable to the idiosyncratic risk that you got from when we were doing CAPM with monthly data. All right, always you have to compare apples to apples. This becomes a big deal when we do options. For now, just for instance, you need to make sure that we understand that 4.16 number percent number is to be compared with the 7% monthly volatility of idiosyncratic risk that we got when we were looking at Apple, and the 16% monthly volatility that we got for idiosyncratic risk of Tesla. So those are the, so from this you can see that the idiosyncratic risk of Wells Fargo is lower than the idiosyncratic risk of Apple, which is lower than the idiosyncratic risk of Tesla. So you would expect, the costs of the market for a security to be efficient are higher for Tesla than they are for Apple, than they are for Wells Fargo. All right, these are some things that we will spend much more time on it later on in the course. All right, what these monthly CAPMs, market models, all of these fall under the grand rubric of asset pricing models. These are ways for us to estimate what an asset would be worth given various data that we have available to us. And that's, for instance, the certainty equivalent pricing formula that I showed you earlier. That's a way of applying all of this. It is also a way for us to say what a particular market would be in the absence of certain litigation related special events. All right, which is what we get into event studies. Event studies they don't have to be just litigation related, but I will show you an example because that's what a lot of the work of event studies are around. Events could be anything that is relevant to a particular firm or to a particular industry. You want to understand the impact of one event or multiple events on a particular firm or an industry, as the case might be. So that is your objective, and that's what we are going to try to do here. So one of the things, the event studies, I actually have a survey on that in one of my papers. It's there in your book as well, where the event study literature really came into its being in the late 1960s on earnings statements. All right, so it has a long history. It is very rich, and I want to just show you an application of events that are often looked at for our particular purposes. All right, so so let's say we have, just as we did before, we have the security of interest. Of security I. You have the return on day T, risk-free security, just we did earlier, average return, foreign exchange rates, everything else that you could need to control for. And these are the bolded ones are the risk-free rates. Sorry, my bad, are the indicator variables for events in question. That is to say, they're equal to 1 if the particular day is in that event. It's 0 if it is not in that event. So event study in general, it is just saying, is this particular event window of statistical and economic importance for us? You could just say, oh, that particular day there was a return of 10%. End of story. No, because you have to say what would have been the return if controlling for all the other factors. The market itself went up by 13%. All right. The industry itself went down by 19%. All of those things have to be built into it, which is why event studies are such a very important part of a financial economist's bag of tools. So we will then modify our CAPM or the market model. Any asset pricing model would add on to it these indicator variables. All right. So the null hypothesis, so you would have just as we did earlier, and for the n events that we have, we would have these lambdas are the coefficients for those indicator variables. These indicator variables, and I'll show you in just a minute, the null hypotheses are that these are exactly equal to 0. That is to say, these events have 0 impact. That's the event study methodology. Now, this part here, these parameters are often based on data or what are called training data from a different period and are applied to the relevant period. And the idea being that the relevant period data might be tainted. You don't know in which way, so it's better to use it from a different data period. The problem, of course, is you use it for a different data period. That's a different model. The industry could be following, the market itself could be following a different model then. All right, so this training data, non-training data, a lot of the times those arguments are often carried on by people who don't really understand statistics. But be that as it may, it's not worth getting into that argument here. The only point to make that I want to make here is that sometimes you use the estimates, the beta hats, from different data period. But in general, there's here, all an event study does is put on indicator variables for the events in question and then test for the economic and statistical significance of the coefficients of those particular events. All right, so this, I'm going to show you this Wells Fargo case. It was, please read it at your, please do read it. But we are going to apply it and look at the different complaints from these. These are the variables, the events that we have extracted. There are 3 events of relevance for us. There is February 26th, 2014 to September 8th, 2016. That's a huge window. And then there is another window from September 9th, 2016 to September 15th, 2016, when some of the information about Wells Fargo's malfeasance was just about being disclosed to the market. And then 9/16/2016 to 9/20/2016, an even smaller window when all of that is disclosed to the market. All right, so what we're going to do, we are going to create 3 different indicator variables, what you might have referred to as dummy variables. Dummy variable, dummy word has such a negative connotation in American English. So instead of saying dummy variable, for people like us who actually work with non-academics a lot, we just avoid using the word dummy, just say indicator variable. So we'll have 3 different indicator variables. So going back to our event study data, we have the Wells Fargo daily return, T-bill daily return, S&P 500 daily return, the comparable that we have isolated as we did earlier, just as it did earlier, we had those. In addition, we now have 3 other 3 other right-hand side variables. They are just like these variables, but they have this very specific property that these are either 0 or 1. When are they equal to 1? When they are between this period of 2/26/2014 to 9/8/2016. So as I said, 2/26/2014 to 9/8/2016, that's the first event window. That's when this particular variable is equal to 1. Then over here, you can see the second variable, the second dummy variable in column G is between these dates that are now being highlighted. So 9/9/2016 to 9/15/2016, those are the dates for which, these are the trading days for which these particular dates, the second event that we are testing the economic and statistical significance for. And finally, the third event is 9/16/2016 to 9/20/2016. So which is, these are the trading dates for which these data are, these values are 1, everywhere else it is 0. All right, so hope that's clear. F, G, and H are indicator variables. That is to say, they take this here, the variable F takes the value 1 only if it is within this window, 2/26/2014 to 9/8/2016. Otherwise, it's 0. Column G takes the variable 1. That's it. It kicks in only if that the date is between 9/9/2016 and 9/15/2016. Otherwise, it's 0. So the coefficient of this particular event of this variable, this indicator variable, gives you the difference between when that particular event is relevant and when it is not. Similarly, the coefficient over here gives you the impact of this particular window. We are going to do just the way we did earlier, going back to our regressions, going to data analysis, regression, B1 to B2139. Instead of C to E, we are going to go C all the way to H. Never to a good idea to make the constant equal to 0 for a market model. New worksheet. WFC event study. Okay. Right. So these are the results of the regression. As I have mentioned to you before, really you should always use the labels and include them in your analyses. Otherwise, it'll be impossible to keep track of which is which. And so this is a very helpful thing to do. What are the important values to keep in mind? The p-value of the entire regression, it's close to 0, practically 0, which is great, to over 2,000 observations. So, that's not surprising at all. The actual values of these intercepts are not as important because of the multicollinearity. The signs, however, are important. The p-values are very important. All right, so let's look at these numbers here. All of these are intended to be control variables. You might remember from statistics, these would be nuisance variables. In the sense, they're not nuisance, but we don't particularly care about them. They need to kind of follow signs so that they make sense. In particular, if this number here, the coefficient of S&P 500 was negative, for Wells Fargo, we would be very worried. Similarly, if the coefficient with the Bank of America was negative, then we would question the entire regression. But apart from that, it's really not that critical for us. What we really, when we're doing an event study, all of that, doing the market model, all of that is to make sure we have a proper model, a model that makes sense. Beyond that, all we care about is these three. These are the events. That's all we care about. Look at these p-values. First of all of those are very, very small. They're pretty close to 0. This one here, let's look at the first event, 2/26/2014 to 9/8/2016. The p-value is 98.02. So that's not a statistically significant result. Similarly, the one at the bottom, also not statistically significant. The one in the middle is negative and statistically significant. All right, so that's what we would look at this. The empiricist, the financial economist, and we are going to come to this and say, well, for this particular um, situation, it's only the second event that was statistically significant. However, let's look at the idiosyncratic risk here. So that is daily. In order to make it into a monthly number, we would have to multiply it by square root of 20. So it has a high idiosyncratic risk, although, you know, the that 4.16 is the monthly idiosyncratic risk. You know, in the grand scheme of things, it's really not terribly out of whack with what we have seen before. However, it is, as I mentioned in the slides, very high in idiosyncratic risk relative to what we see in some other securities. All right. So this here 0. That's the daily volatility in monthly terms. That comes out to be 4.16%. So that's what our the numbers are. That's what the cutting edge financial analysis of this whole scenario is for our um, for our uh, for our question. Did this have the impact that the federal government was accusing Wells Fargo of doing? And the answer really is that the bigger window, once you control for all the appropriate market and industry movements, there was not a statistical or economically significant impact. So that's something to keep in mind looking forward. One thing that is actually, I'm going to just show it to you on a, we can do it with this, but I also want to show it to you with Tesla, because I love looking at Tesla data, is what would Tesla's, you know, it's interesting to look at Tesla and see, you know, it's, you know, how much it has moved and price. But, you know, for us to get a sense of what all of these means is this, it is very simple idea of pegging prices. All right, so on the first day of the Tesla closed, on the first day of trading, it closed at $23.89, okay? And this was the daily trading volumes of all those dates from that point on. These were the column E is the daily returns of the S&P 500, and G is the daily returns of Ford. You know, just another, I'm just picking another automobile company as a comparable, but we'll see. We'll look at the, in this case, I'm not going to do any econometric analysis. I'm going to do what in Wall Street they say charismatic visualization. So I'm going to put some diagrams in there to see what it looks like. What is the first thing? What is this pegged price? I'm saying this $23.89, instead of buying one share of Tesla, if you had bought one share of that S&P 500 index itself. And then, therefore, you start off at the same price, but then it grows at the daily rate of the S&P 500. So you see, it's F2, it's the previous day's price growing at E3. Not the first price is Tesla's price, yeah, but it's growing at S&P's rates, and so on. It's every time it's growing from the previous day, growing at the previous, but the growth rate is the rate of return of the S&P 500. Similarly, you take Ford and say, all right, instead of $23.89, instead of buying one share of Tesla, if I had bought one share of Ford at $23.89, that would have grown at the rate at which Ford equity grew. Growing it at the return at which Ford's equity gave a return. So H11 growing at 1 plus G12. You grew it at G, which is the daily return of the Ford equity. All right. So therefore, we are going to plot date, closing price of Tesla equity, price of S&P equity, price of Ford equity. Insert. I'm going to have them all as lines. All right. So look at this. That gives you an idea of how differently Tesla has done from the rest of the market or the industry. So on this in the same day of the first day of trading, this is how initially, so that, it's the same amount of money at that point, but growing at different rates of returns of these different securities. All right. So the blue here is the Tesla, is the closing price of Tesla. The orange is the price of the S&P 500 pegged to Tesla's opening price, not opening price, closing price on its first day of trading. And the gray is the price of Ford pegged again to the closing price on Tesla's first day of trading, but grown at Ford's rate. That's the orange. You can see how much more Tesla has grown, but also you can see how much more volatile Tesla's equity has been over this time period. This chart, which is posted on your Blackboard, I have in addition put on the right axis. I have two vertical axes. This the left vertical axis is the left vertical axis is the price. The right vertical axis is the volume. So I have, in this case, this once again, part of that charismatic visualization. There is no econometric analysis here, but it gives you the sense of the volume that was traded on Tesla on those various different dates, but on a different axis on the vertical axis on the right hand side. Two different axes. So as you can see, the blue line is the price of Tesla. Pegged, unpegged doesn't matter because you're pegging to itself. That's just the unpegged. The gray line here is that of the S&P 500 pegged to Tesla's first traded price, first closing price on the first day of trading. And the orange, whatever this color is, price of Ford pegged to Tesla. And this this here is the volume. As you can see, that's where it really takes off. There is some volume. And you see there is this part here, Tesla becomes a very heavily traded stock. What we will later see that volume is a function of the divergence in the valuations between different investors about the same security. All right. It does not mean that the more volume there is of a particular security that the markets are efficient. It just does not mean that. But we put it in here in order to have a sense of how various different information dispersions came into play during this entire period. All right. So if you find yourself investigating, you're being tasked with doing the financial analysis for a class action or a litigation of other kinds, these are the first steps you should always take is do the CAPMs and the market models, do them for, look at the relevant events, plot the graph, the prices and the volumes across those events, do the relevant econometric analyses, but also do these pegged charts to get a sense for how all of this worked out. All right. I hope you all have a great day. Take care.